Welcome to the Army Empire Podcast, your go-to podcast for insightful tips on investment strategies, entrepreneurship, and all things money matters. Join Bernard Alerte, your guide on this journey to financial freedom. Each episode will dive into expert advice, practical strategies, and inspiring stories to help you take control of your financial future. Whether you're an aspiring entrepreneur or a seasoned investor, we've got something for everyone. So get ready to unlock your financial potential and make your money work for you. And now, let's welcome your host, Bernard Alerte.
Hey, it's a beautiful day.
Yes, it is. Absolutely.
It's a beautiful day to learn a little bit more about all things money matters.
Yes. We're excited, man. We have a lot of cool stuff to share today.
Yeah, it's going to be fun. How's it going over there, Bernard?
Doing great. Very, very excited. Very excited what's happening. It's crazy because the podcast we had today, I've been getting so many calls. Everybody's watching the news, and I've been getting some calls from a lot of clients. Oh my gosh, so the market, being in a financial field, the market's been down the past week, and everyone's so nervous. Oh my gosh, what's happening with this? Tariffs, this, all these things. They're cutting the government, laying people off, and all these different things that are happening, and people get nervous sometimes, right? So because it's easy to get caught up in the news. And I say, you know what, let me do a podcast on that. Let me do a podcast on that just to educate families out there. Also let them know what's happening, the right mindset, no matter what's happening, to stay. And one of the slides, which we're going to go over, says, invest with your head, not the headlines, right? Which is so cool.
Oh, I love that. Well, let's go ahead and just welcome, first of all of those who are watching we have YouTube right there. Hello, Coach and Liz. Hello. On YouTube, we have some folks joining us already on Instagram and right here on Facebook. Thank you so much for joining us. Don't forget to comment, to like, to share, to subscribe to all the platforms. And absolutely, as always, grab the pen and paper because we are going to take some notes. I love that you're able to I'm sure you're getting the messages saying, hey, there's all these things going on. So what can you share?
What should I do? What should I do? And you know what? And here's what I always tell. Why? And the topic of the talk today is, why is it a great time to invest, right? Why now is always a great time to invest. And no matter what's happening, every single time is a great time to invest. And let me share with you why. It seems counterintuitive, but it is. If you think about that, this is the bear market versus the bull market. Everybody see that? We see the bear, the bull, and no one really knows what does that actually mean, bear or bull market. And I'll explain. The bear market is when the market is going a correction. Let's say it's going down a little bit, the stock price is going down a bit. That's called a bear market. A bull market is when everything's going up. The market is going, the S&P 500 is going up. So that's what I call a bull market versus a bear market. That's why if you look at the Wall Street, right? Actually, in Wall Street, there's a big bull. There's a big, huge bull that everyone like a tourist goes and take picture of in New York City. That's exactly why.
Okay, I want to look at that again. So it's bear means what?
The bear is when the market is going down. It's going the correction, right? Bull is when the market is going up.
I love that. Ready for our first slide?
Absolutely ready.
Here we go. Thank you, Jenna. Jenna has already shared the podcast. Thank you.
Absolutely. And if you think about there's always a cycle of market emotion. What happens is when the market goes up and down, there's a lot of emotional things that happen. People go to a lot of emotional, and that's what happens. Sometimes they make the wrong decision going emotion. This is the emotion that happened. Let's say if you look at this, right? In the past 50 years, the average stock market has nearly like 11%, pretty much, right? Average about 11%. And that's include natural changes, right? Performing, right? If you think about what's happening, right? Let's look at the going up market. When the market's going up, there's what? There's optimism, right? Everybody's excited. Oh my God, it's optimism. There's excitement. There's a thrill. When it keeps going up, there's a thrill. Last year, the market went up 20-25%. Oh my gosh, euphoria, right? And if you think about that, at that point in time, this is where sometimes it's kind of dangerous sometimes, right? Because what happens, people get aggressive. People go, oh, they hear about this. I heard about this stock going, they're 50%. Let me put my money in there. No, that is where people make mistakes, right? And sometimes you feel like, oh my God, why am I so smart, right? Everything's going up. You see your portfolio going up. So you get excited. But guess what happens? It also shifts, right? It starts shifting a little bit, right? It's like what's happening right now. If you look at it, everybody's going through some anxiety. There's anxiety. Everybody like, oh my God, you're nervous. What's going to happen? And there's denial. It goes to denial, then fear, right? It goes even more, then desperation, right? And this is when people make the mistakes, right? But this is where, see, when it goes to between fear and desperation, what are some of the things that you have to say? Is temporary setback. I'm a long-term investor, right? Unless you're retiring tomorrow or next week, you don't have to worry about it. For most people, it's a long-term project, right? The desperation, panic, and that's when people panic, pessimism, right? How could I have been so wrong? And this is when people make mistakes. People, man, you hear your friends, oh, get out of the market, take your salary, stop, go put your money in cash, put your money in the bank, put your money under the mattress, right? Mm-hmm. And this is when people make mistakes. Then guess what happens? It goes back up. It starts transition. Then there's a little skepticism, right? It's like, oh my God, is this really gonna happen? Then guess what? There's hope. Oh, it is doing good, right? Then relief, then optimism. So and it's like a cycle, emotional cycle people go through, right?
Yeah.
But what happens is when you make decisions based on emotion, when it comes to money, when you make emotional decision when it comes to money, always the wrong decisions.
Oh my gosh. Jenna said she almost bought Bitcoin today because of the shift.
Exactly.
Because it's emotional. It's an emotional thing that happens to us. I love that we're looking at this roller coaster ride of emotions.
It's a roller coaster ride.
Yes, the heavy hitters are live. Thank you, Albert.
Absolutely. It's so true. So that's what happens. So there's a market. It's like, and I was like, I'm glad you mentioned the analogy of a roller coaster, right? Think about it. If you're on a roller coaster, when's the best time to get off a roller coaster? When it stops. When it stops, you get off. You don't jump out of a roller coaster. You don't jump out. No, that's when you jump off, right? When it stops, that's when you get off. So when you've hitting your goals, this is when you make adjustment. If your goals have not changed, don't make any changes, right? So this is the emotion people go through, and this is a reason, right? If you look, I mentioned the market has been averaged about 11% for the past 50 years. If you look at average rate of return, but guess what happens? The average investor return is 3%.
Yeah.
So most investors are getting 3% on their money versus the market getting 11%. Why is that? Because what happens is most people invest euphoria at the point of maximum risk. This is where they invest, right? And guess what happens? When it starts going down, they sell. They get out of it, right? It's like you have to look at the market. And I like to use the analogy. You have to look at the market as if you bought a house. Let's say if you bought a house and you live in the house, right? And you stay in the house. Let's say the house price goes down, for example, right? What do? You don't sell your house. Guess what you do? You stay in the house. Listen, I'm living in this house. The market, maybe the value has gone down on paper. Now, when I sell the house, this is when I take a loss. So guess what? You stay in. You don't sell your house. If you see oh my gosh, it's appraised as this, you don't get out. You stay in the house. You stay the course, right? So this is the market, right? So let's look at the next slide, right? The next slide, we talk about invest with your head, not the headlines. And right now, there's so many headlines. If you think about, there have been plenty of reasons not to invest in the market for the past years. And long-term investors, right, the results have generally been very positive. This is how the S&P 500 is done for the past since 1994. And if you look at every single year, I know it's very small. I put my glass, I can't even read, right? Average return. Think about things that happen, right? Since 1994, right? Great things happen, right? If you think about even the past couple of years, coronavirus affected, right? If you think about everything, the Iraq war, all these different things that people go through, right? If I look like financial crisis, 2008, mortgage foreclosures, rising prices, the Ukraine war a couple of years ago, all these different things that affect people, no matter what happened, the market has kept going up, right? See, if you invest $10,000 in the market in December 1993, if you stayed the course, it would have grown to 181,000 at 10% return over that period of time. So this is why invest with your head. There's always going to be a headline. There's always going to be something. Tariffs. We're going to add tariffs to that soon. That's going to happen. But guess what? You got to stay the course, right? If you look at the red, but if you look at the bottom, right?
Way down at the bottom of that one.
The bottom of that slide, right? If you look at
Yeah.
the green, you see greens and reds.
Mm-hmm.
See, greens is how positive the market's been. Red is maybe the negative part, the years of market. So if you think about it, since in 1994 to 2024, that's 224, that's over a 30-year time frame. There's been 3, 5, 6 down years and 24 up years. So why would you wanna make a decision based on 6 down years?
Right.
So this is why it's so important. It shows you visually what happens to the market over a period of time. All right.
That's really good.
Absolutely. So if you look at the next slide, this is Warren Buffett. Warren Buffett, for the CEO of Berkshire Hathaway, this is what he said: bad news is an investor's best friend. It lets you buy a slice of the American future at a marked down price. Right? And see, that's so when the market's right now, a lot of families come, listen, what happened? The market, like, it's a sale. Invest some more money. If you have some money, invest some more money, because you can buy shares at a low price. You have to look the same way. You would never buy a house at the highest point. When you buy a house at the lowest peak, right? Now, let's say if you think about it, right? Let's look at real estate, so people can understand more familiar with. In other words, right? Let's say there was a real estate crash, a mortgage crisis in 2008, 2001. Everything went down. When was the best time to buy a house? It was in 2008. It's 2008. This is the best time to get. Was the best time when there was houses. Unfortunately, people with foreclosures. Those were the best. If you were an investor, now for families, that was devastating for a lot of families. But if you were an investor, the best time to buy a house is at low prices. It's the same thing with the market. It's the same psychology, same math that works in real estate works also in the market, right?
Mm-hmm.
So whenever you have to take the path, whenever you see, oh man, everybody get out. When your friends and family tell you got to get out, do you see market? You do a total opposite. In other words, right? So if you look at the next slide, right? And this is the best, but after this is what it tells you. This tells you at the end of the bear market, what happens to right after, let's say, a year or the market went down. What did it do the next year? Look at this, right? Other than 2001, right? It went down 11%, right? But guess what happened in 2002? It went up 36%. 1 year return, 5 year return. You see it?
Yeah.
See the difference? 2008, after the market crashed in 2000, went down 36, 30%. Guess what happens? It went up 49%. That's why I always tell, when I remember in 2008, as I said, do not make a move, whatever you do, unless your financial situation has changed, unless your goals have changed. Do not make a move. As a matter of fact, if you can invest more money, invest more money. And guess what happened? The people that stayed the course did well. 2009.
Hey, I'm with Robert Brown here. He's saying stay the course. That's exactly what we're hearing here.
Stay the course. 2020 up 70. See, that's the difference. Stay the course. If your financial goals haven't changed, should you approach your investing? We can help answer that question, right? So let's take a look at the next slide, right? See, there's proven fundamentals that if you use those fundamentals, no matter what happens, you'll do okay. You'll do pretty well, okay? And we talked about the past podcast when we talked about more about investing, mutual fund, invest professional money management. And there's 3 simple concepts. If you apply these concepts, one is dollar cost averaging, right? All it means is if you're investing money, this is for people that are investing money on a monthly basis, or if you have a 401k, for example, and your money's coming out of your check every single week or every 2 weeks, right? See, investing a fixed amount at a regular interval eliminates having to predict when to invest, as you will be able to take advantage of the market highs and lows by purchasing fewer units when the prices are high and when units are low. So what does that actually mean? That means you get a sale, right? If, for example, if you can get 2 for 1, why not? right? And so whenever if you're investing money consistently on a monthly basis or every week, it doesn't matter what the market does, right? And I'll show you an analogy, right? What it means. The second one is discipline, which is the hardest part in the middle, is by staying focused and staying invested to the market activity, you can increase long-term potential, because missing even a handful of best performing days makes a big difference, right? Over a period of time. Diversification by investing in different. This is why mutual funds are so important. It gives you a way to diversify. It gives you a way to you'll be able to invest in different industries without going individually. And it takes all the research out of investing. So you're able to be on automatic. You know what you're doing. You pick a fund that's really comfortable with different asset class, and you stay the course, right? In other words, right? And I'll show you. Look at the next slide. Let's talk about dollar cost averaging, because I think it's so powerful, right? Think about it, right? If there was two investors, right? This is a proven method, dollar cost averaging. If I was to tell you, which investor would you want to be? The one in a rising market, investor one, right? They're investing $100 a month, right? One is in a rising market, just going up like that, or one that fluctuates, like I showed you, going through the motion, right? That fluctuating market, right? Which example would you prefer? For most people looking at it, they will say a rising market, investor A, rising market, right? But let's take a look at the actual numbers, right? If you look at the next slide.
I'm so into this.
Yes. Look at the next slide, right? For example, investor A, if you look at the share, because whenever if you're investing $100 a month, for example, right? What happens? You're buying shares of a mutual fund. So let's say the share price is $10 a share, you're buying 10 shares. If it's $20 a share, you're buying 5 shares. Very simple, right? So if you think about it, if you have the investor A where share price goes from 10 month to 12, 14, 16, 18. So what you're doing, if you're investing $100, you're actually buying less shares over a period of time because the share price is going up because you're investing a fixed amount. Guess what happens? You accumulate 42 shares, which is not bad. Looks like investor B. Investor B is still at $10, they're 10 shares, right? Guess what? The third month, $7 a share. It went down to $7 a share. Guess what? Since you invested 100, you bought 14 shares. You see that? You bought 14 shares, right? Let's say month 4. Guess what? It went down $4 a share. This is where, if you think about it, oh my gosh, the share price went down almost 50%. Guess what you did? You bought 25 shares because you stayed the course. See, at this point in time, when it goes from 10 to 7, 7 to 4, this is when the slide I showed you the emotion, panic sets in. And people, I'm out. That's it. I got to stop. And they move their money into something, cash or something, right? But this is where the fortunes are made. This is where you can get wealthy. This is where wealthy people, investors, make most of their money, right then and there. Guess what happens? You bought 25 shares. Look at it, just a small 6-month time frame. The same money invested, you accumulate 126 shares. 126 shares. Exactly, right? It's the same way. If you were to tell someone, is it better to buy, let's say a house is worth a highest price at the high 500,000, or is it better to buy 2, 3, 4 houses worth 100,000 each, 200,000 each? Which is better? Buy more houses, because when the houses go up, guess what happens? It compounds.
This is totally what we need. Literally drop some money emojis if this is making sense to you. And if you're thankful that we have somebody like Bernard who is opening up our eyes to understand this so that we're able to see it. Because when you look at that first slide, oh, absolutely, you're thinking, oh, I want to be the first one.
Exactly.
I want to be A. I want to be A. But when you have someone to explain, just like Bernard just explained to us, this is why having a financial coach is so important, is that you realize, oh, wait a minute, this is completely not what I thought. He's pulling the layers back so that we can see and understand. Show me the money emojis. Listen, if I was watching, I'd be like, money emojis all the way through, because you're letting us see exactly where we're going to be putting our money.
Exactly. As a matter of fact, let's say right now, we don't know what's going to happen. It might go down a little bit, right? Guess what? Invest more. Start putting some more money. Invest some money. If you have your 401k, if you were getting 8% or 10% of your income, increase it to 12% or 13%. That makes a huge difference by doing that. So this is so powerful.
Yeah.
So no matter what, dollar cost averaging takes everything. Now let's talk about diversification. Mutual fund. We talk about what's mutual funds. Mutual funds is there's individual investors and your money's professionally managed. So your $100 a month is invested, is pooled with the same amount of. Let's say if you have a big institution that's billions of dollars, is invested the same way, managed the same way, and look at the difference. Guess what happens? Mutual funds. There's a lot of companies. Average mutual fund owns almost 150 stocks. So rather than invest in one stock, say if you invest in one stock, it can go up and it can also go down.
Right.
That's, but if you have like a portfolio that has 150 stocks, a lot of companies where then and you're able to invest in the market. Like people tell me like, oh, I want to invest in Apple, I want to invest in Tesla, I want to invest in Nvidia, I want to invest in Amazon, I want to Disney, all these. No, guess what happened? You find a mutual, you can invest in all those. Find a mutual fund that has all these companies put together, and this way there's diversification.
Yes.
And you have professional money managers. Their goal is to make money for you. So they're gonna track everything. So they're able to, you know what, this fund's not doing that good. Let me just take some money, sell that, and they're able to move the money around. So you don't have to sit around and guess and oh my gosh and look at the every single data research because you paid them to do the research.
Yeah.
Right. All you have to do is stay the course, able to have that, right? And you're able to get some mutual funds is probably one of the best places for an average American to invest their money for their retirement, for their serious money. Absolutely 100%.
And literally the typical mutual fund does hold about 150 stocks on average.
Yes, a lot of some old less, some more. It depends. And that's the best part about that, you know. So I always tell people there's serious money and play money. Your serious money, you need to be professionally managed, like in a mutual fund, managed account, or annuity or something. Play money, then if you want, like Jenna says, let me try Bitcoin, right? I'll invest some money in Bitcoin. If you want to do that, but you also have to understand you're taking a risk.
Yeah.
You lose it also, right? If you can't afford to lose it, do not invest it in something aggressive, something you're not too sure. But if you say, you know what, this is money for long term, I have a time frame, right? I'm good. And if you're not sure how much, which one money, we have past podcasts. We talked about the best way to save and invest to use, you know?
Yeah. Yeah. That's so good. So good. So you said the play money. Say what you said a second ago. It was something about
there's two kinds of money. There's serious money and play money, right?
Serious money. Serious money
is money you can't afford to lose. Mm-hmm. You can't afford to lose. Play money says, man, if I lose that 5,000, 1,000, 10,000, it's not really going to affect me financially. That's play money. Your serious money should always be invested in professionally managed funds.
That right there. Serious money.
Yes,
be in
managed funds.
Perfect.
Play money, if you want to, oh, my cousin told me about this and about that, and give it a shot. He doubled his. I don't believe in that, to be honest with you. And I've talked about that. If someone tells they can double your money in a year or 6 months, run away, run as fast as you can. Delete, relocate your house. Don't answer the calls anymore. You just do everything. I'm telling you, right? And look at the difference. And I believe this is such a perfect example. Making wrong decision. This is a tale of 5 investors, right? 5 different people, right? If you're 5 investors, there's 5 investors that invested $10,000 in the stock market, S&P 500, in September 2008, right? If they kept their investment to the market crash in February 2009, by the end of the March, right, that $10,000 turned to $5,800 because the market went down. Now, what happens to most people now, we're going to see the difference between someone emotionally, right? What the mistakes that they made. Look at investor 1, which a lot of people did, unfortunately. They sold the investment, that $5,800, right? And they said they put it under a mattress. That's it. I'm never gonna try again. That's it. I lost money. And guess what happened? By the time you get to 2000, right? If you look, they would have $5,800.
Yeah.
That's it. It wouldn't have grown. As a matter of fact, they lost money because inflation went up, right? Mm-hmm. Now, investor 2, what they did, they sold the investment, right? That's why they sold the investment and they put it in a money market fund where they got maybe less 1% or 2% interest. So that 5,800, they say I'm gonna be, I don't want to lose any more money. And guess what they did? They have $6,500 now, right? Investor 3, guess what they did? They held on to the investment, but they did not begin a monthly investment. So what they did, they say, you know what? They didn't add any more money to it. They say, you know what? I'm gonna leave the money in the fund. I'm not gonna touch it. And they did pretty good because now they have 50,000 because they did not move. They said, let me keep it there. It's long term. I don't need to take it out. Now, investor number 4, they sold the investment, right? Not only they sold the investment and they put it in the money market, but they added $583 a month on top of that. Right? And now, so they invested 109,000 total. And guess what? Now they have 120,000. Right? Investor 5, which we encourage every single person to be. Guess what they did? They held on to the investment. They said, oh my gosh, I'm going to invest more money. On a dollar cost average. And guess what happened? That account grew to 349,000. So that's in a 14-year time frame. In the 14-year time from 2009 to 2020, end of 2023, guess what they did? They say, you know what? They understood. They listened to Bernard, right? Or someone like me, right? I told, listen, just keep investing money. Just keep your invest money every month. Don't worry about it. Just don't. And guess what? You're dollar cost averaging. And by doing that, that account would have grown to 349,000.
Look at the difference. It's crazy.
That is the huge difference. You know, wow. Because no matter what happens, listen, and just to wrap it all, Warren Buffett says, let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't the faintest idea to where the stock markets will be higher or lower a month or a year from now. But what is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. So, listen, I'll tell my clients all the time, listen, I can't predict if the market is going to go up or is going to go down. But if you have the right strategy and you stay the course and you stay engaged and you take the emotions out of it, and you'll be okay. Yeah. You'll do all right. Don't make bad decisions. Don't listen to all the people. Listen to your advisor. The only person you listen to. And one thing that's very scary right now, because and I talked about IULs a couple of shows back. And what happens, this is people have to be careful. Oh, see what happens in the market. Put your money in IULs and don't do that. Whatever you do, don't take money that you have invested in your retirement plan, put an IUL or somewhere else. Stay the course. If you're not sure, speak to an advisor. Speak to someone that's investment licensed. Yes. That has a securities license. Speak to someone that has investment license. They can guide you. Okay, because they'll understand what the market. They're not gonna have you. If you speak to someone that just maybe have a life insurance license, nothing wrong with that. They're gonna gear you to something that's not gonna benefit. That's gonna have a lot of fees, and that's not gonna benefit. You will end up losing no matter what.
No matter
what. Stay the course. Stay the course no matter what. Now everyone's different. Everyone has a different risk tolerance, right? Everyone. So sit down with your advisor and say, listen, figure out your risk tolerance. Maybe you can't deal with that fluctuation. So whatever it is, but stay the course. Whatever you say, stay the course and have someone that you can trust, that's going to give you the right information, that has the experience, that's seen the ups and downs, that can guide you the right way.
Oh, I like those two words, risk tolerance.
Yes.
That's why it's important to sit with someone so you can understand, because not everybody has the same risk tolerance. That is really good. I think the key points here throughout the entire episode, these past 25 minutes, has been stay the course, invest with your head, not with the headlines.
Yeah.
Yeah, you don't want to do that. History is a great teacher. And look, Lori just said, and I agree with her, take the emotions, just like you said, Bernard, take the emotions out of it.
Yes.
That's it right there. That's it right there.
When it comes to money, the only reference point that you need to use money is logic. Emotions, when you use emotions, you're always going to make the wrong decisions when it comes to money.
Yeah. Well, next time I see these two, I'm going to look at it with a different mindset.
Exactly. Yeah. Bull market. Yes. You'll see the big difference.
Guys, thank you so much for joining us. Those who have been with us on YouTube and on Facebook and on Instagram, thank you for joining us and for your comments. Yes, oh, absolutely, such a valuable individual. That's Bernard. That's Mr. Alerte for you. So good. Thank you so much for always blessing us every Tuesday with these amazing episodes, encouraging us, educating us, giving us so much knowledge when it comes to all things money matters. Thank you so much. And we will see you again next week. Anything else exciting you got coming? You got anything else under your sleeve?
Yeah, we have a couple podcasts, a couple things. We'll couple things we're working on for next couple.
It's gonna be good. We're coming into spring, guys, and we are excited for everything that's ahead here at the Army Empire podcast. We'll see you again next week. Thank you, Bernard.
Take care, guys. Take care, Liz. Feel better.
Thank you. It's been a crazy 4 days, but I'm already there. Thank you, guys.
Absolutely.
Bye-bye.
Take care, guys.
Thanks for tuning in to the Army Empire podcast. If you enjoyed this episode, don't forget to subscribe and share it with your friends. Join us next week for another exciting edition, and until then, keep building your empire.